In the last part, we were examining different technical details of US Treasury instruments. We're going to pick up on slide 19. Again, US Treasuries are quoted without accrued interest, and we need to make an adjustment for that. And so remember, the quoted bond price is the value of the bond less accrued interest, or the value of the bond is the quoted bond price plus accrued interest. And so there's two different ways that you can actually calculate accrued interest, or there's many different ways. There are many different ways to calculate bond valuation, just depending on your compounding methodology. The two illustrated here are discrete compounding and continuous compounding. And you'll get different yield to maturities, but the value of the bonds will not change. So with this particular set of data, we can run some calculations. And so in this particular case, we determined that there's $1,222.83 of accrued interest on this particular investment as of this particular trading date. And so the bond valuation can be run basically taking the yield to maturity that was found are given. We can compute this bond value. 113 seconds implies 100.40625, which is the quoted price. If I add in the accrued interest, what we see is our valuation model is extremely close to what the quoted price of the bond is. And so we know that yield to maturity in our model is correct because we get the value of the bond price back. There is some rounding in the yield, so you would not expect it to be perfect. Solving for bond yield to maturity, like we did in the embedded function module in chapter 3, we basically can derive from simple bond math. The yield is a function of the quoted price and all the other parameters. It doesn't matter whether we use continuous compounding or discrete. In the continuously compounded version, I could solve for the implied yield to maturity and get the continuously compounded yield to maturity. So with discrete compounding, we could solve for the bond valuation model that gives me the quoted price of the bond and set that equal to 0. It turns out if I use the yield to maturity provided previously, in fact, that gets a value of 0. Well, yield to maturity has some severe weaknesses. If I'm comparing a 10-year bond with a 5-year bond, there's 5 years of overlapping yields. And so what is the marginal information of the 6th year, 7th year? And so it's difficult to compare yields to maturities. The sharply declining volatility of yields for longer maturities is one of the phenomena that we observe that has to be addressed. And there's also coupon effects. The higher coupon bonds tend to have something known as a shorter duration, which causes their sensitivity to yield changes to be different. And so yield to maturity is just basically inadequate in addressing how to appropriately value US Treasury instruments. So let's consider the LSC model. If you recall, it's a simple transformation of maturity with the scalar, and that's regressed on whatever the variable is that we're trying to fit. In this case, it's CMT yields. And so we're going to consider the LSC model, assuming a scalar of 2. And so, and if we apply this to continuously compounded yields, we can build out a model where the value of the bond is equal to the cash flow at each point in time times the appropriate discount factor. That appropriate discount factor is basically just discounting at the fitted yield to maturity based on the LSC model. This LSC model is going to be fit using however many factors I want to use to fit the curve. And so the spot rates and LSC estimated spot rates can help improve U.S. Treasury bond valuation. And so relative valuation, we would argue that the value of the bond ought to be approximately equal to the LSC value. And applying this LSC model, each discount factor is based on the fitted LSC model. And so this is a little different in the sense I have different yields or different discount rates for each maturity as opposed to the constant yields that we were looking at before, where we don't allow the yields to vary across maturity. We're now allowing for the yield to vary for each cash flow, and each discount rate is fit by the LSC model. And so the discount factor is based on the LSC model, and we can deploy it that way. There's several pieces of R code that support this analysis, and we'll look at that when we dive into the R code itself. The traditional analysis, we have coupons remaining, the period elapsed, fraction elapsed, accrued interest, bond value, time to maturity, price difference in order to solve for the yield to maturity, and we can build out a yield to maturity solver and basically do these calculations as we did in the embedded functions module in chapter 3. And so we have a data frame basically of the bond input data. With that data frame, we can do a whole host of calculations based on pre-built functions. And these functions can value the bond, for example. If I deploy the LSC model, my interest is the spread over the CMT, and that'll be the calculations we make. The US Treasury parameters for the portfolio will be provided. The CMT parameters will be provided, and the outputs will be various data derived from valuing US Treasury bonds based on the CMT curve. By applying the LSC model to constant maturity treasuries, this illustrates a four-factor model. If the line with the triangles in it is the LSC fit of the CMT curve, and the line with the pluses in it is the zero coupon discount factors continuously compounded. It's important to understand the context of this analysis. What we're doing is we're building out the base curve upon which to value the entire set of existing Treasury notes and bonds, and then seeing which are over and which are underpriced. This is not a get-rich-quick methodology, because there are structural reasons for bonds to trade off of this curve, but it's just illustrating how to apply the LSC model within the context of US Treasuries. You can compute the relative error of the LSC fit. If you'll notice, typically bonds that are right at maturity are not going to fit well, and our focus is primarily on the short end of the curve, and so the relative bond error is small. At the back end of the curve, it is fairly large, and the absolute error as a percentage of par, we get the same sort of phenomenon. The yield differential in basis points, again, at the short end, you're going to get some annualized yields that are significantly different, but within the typical region of focus, it's fairly accurate. So in summary, we reviewed the technical details of US Treasuries, pointed out some weaknesses of traditional valuation approaches. It's basically running in a circle. You start out with the quoted bond price in the market. You compute the implied yield to maturity. With that yield to maturity, you then circle back and calculate the quoted bond price. And so there's not a lot of advantage that comes from that exercise. If we apply the LSC model, we at least have some sort of independent valuation methodology to appraise the entire set of US Treasuries outstanding. Let's turn now to examine a little bit of the R code. As we proceed through the book, we'll begin reviewing less and less R code and focusing more and more on the quantitative finance side, assuming that by now you're able to read the R code fairly well If you'll notice, there's several constant maturity Treasury files as well as US Treasury information that's available just from prior exercises. If we open this particular piece of R code, again, depending on how I left it, you'll find residual information. And again, there's several files that are available. Let's first focus just on valuing US Treasuries. And so if we walk through this piece of code, again, take out the trash, we're going to be using the date function and the Optimex function in order to compute yield to maturity. And so if we take a particular US Treasury bond where the input data is given, and so we have the quoted bond price, and we have the twice a year semi-annual pay, it's 2.25%. The stated yield to maturity, I believe I got this off of Bloomberg, was 2.535235, and the settlement date was January 17, 2018. The maturity date is November 15th, 2027. And so there is a source file of US Treasury functions. And so if you'll notice, at the moment, there aren't any functions available. When I run that file, there's a whole host of functions that are based on UST functions. And so if I take a look at this particular file, I would encourage you to spend some time and try to understand. This calculates how many coupons are remaining. It starts at the maturity date and works backwards until it crosses the settlement date. And that is able to estimate the number, or be able to calculate the number of remaining coupon payments. There is the flexibility to do more than just semi-annual, how much time has elapsed, and there's several other functions. Again, I don't want to spend too much time going through these different functions, but you can easily begin to work your way through them, get familiar with them, and try to change a few things. And so I create a data frame of bond input data. What you'll notice is I will pass that information into these different functions and are able to calculate a whole host of different data points that I can check. How many days have elapsed, how many days are in the semi-annual period, what's the fraction of the period that has elapsed, which is 0.348. There's 20 coupons remaining, and it's a 9.82 years to maturity. And so again, there's several other things that could be calculated. If you'll notice, the the model quoted price and the market quoted price are identical. That's in part, again, running in the circle of starting with yield to maturity. You get the price, you get the price, you get yield to maturity. This is just basically demonstrating that the model is working correctly. If we turn to the US Treasury spread over Treasury, this is, the US CMT, we can calculate the spread over Treasuries. If I just highlight the whole thing and run it, we can see what it does. And it generates several plots. It'll do a variety of different calculations. It takes a while to run because it's going over the entire Treasury curve, building out the LSC model in order to calculate the error amounts. And so, again, without spending too much time down in the weeds, this is basically taking a particular set of US Treasury data. So this is UST and January 24th. So if I pull up January 24th on the USTs, I could view this file, and this is basically a spreadsheet with all the data. I believe I pulled this data off of the Wall Street Journal, and then I can do an analysis of every single one of them by applying the January 24th CMT yields, and able to use the CMT yields to build the zero coupon discount curve, continuously compounded, and with that come up with fair value of the bonds, and then with that come up with different errors, and that helps in being able to estimate over and under valuation.